This is where I like to start. So here's the current makeup of Congress right now. And as we look to this election, if we have to look at the outlook, I would say I think the numbers are roughly going to be very similar. They might even be close to the same. Those colors might change a little bit, but I think the numbers are going to be very, very similar, meaning whatever happens when the dust settles after the election, that in the House, it's going to be a very thin margin. The Senate could be 51-49, 50-50. We're not going to see a 57-43 split in the Senate. It's going to be very, very narrow either way. So what that tells me is that either policy, regardless of who's in the White House, and regardless if someone, wins, if one party controls the White House, the House, and also the Senate, it's still going to be challenging to push through major legislation. But all it's going to take, especially in the Senate, is just a few holdouts. So if you're thinking, if you're hearing this noise in the media on, oh geez, one of the things I've been hearing, there's talk they're going to raise capital gains rates to, over 40%. I think that's highly, highly, highly unlikely. Even when we saw in 2022, the Democrats control, obviously President Biden, and in the White House, we had a Democrat-controlled Congress. They had a package, a larger package, a tax package called Build Back Better. It did pass the House, very narrowly passed the House, did not pass the Senate, even though they had a majority in the Senate. So again, I don't think whoever wins the White House with this type of Congress, it's not going to be a full mandate to do whatever they want. I think that's not necessarily bad news. It takes a lot of uncertainty off the table. And by the way, markets value certainty. The markets, either way, if it's a Republican president, Democrat president, generally it really doesn't matter long term, and Taylor might touch base on this a little bit. But the markets appreciate certainty versus uncertainty, okay? Taylor will cover that a little bit more. Here's our House, here's a Senate outlook. We'll start there. And this is a really busy slide. There's a lot here. We can get you a copy of the slides. But this is what I want to leave you with. It's going to be a really uphill battle for the Democrats to maintain control of the Senate, okay? It's going to be a very much an uphill battle. And it's not just because they're defending more than twice as many seats as the Republicans. It's where those seats are. The Republican seats are roughly safe all the way over here. Then you're on the Democrat side. Well, if we go back here, we show it's 51-49. I really call it 50-50 when we're looking at the election, because the West Virginia seat, formerly held by Joe Manchin, he's not going to run for re-election, the Republicans are going to pick up that seat. So if I'm a Republican strategist and I want to take control of the Senate, I want to at least get to 51, right? Because I don't know who's going to be in the White House, right? We just need one more seat. That's the way a Republican strategist is thinking. And where are they going to start? They're going to start in Montana. Joe Tester's seat in Montana. Trump will win Montana. He will win that handily. It's a matter of whether Joe Tester can differentiate himself and hold on to that seat. That's going to be a big challenge for him. So that's going to be the lowest hanging fruit for the Republicans. There's a few other toss-ups in there. Michigan to some extent, Nevada, Sherrod Brown in Ohio. But the Montana seat is probably the best bet for the Republicans to pick up another seat. Conversely, in the House, if I'm a Democrat strategist, I feel pretty good there. Especially that last bullet point. There's 17 Republican congressmen, congresswomen who are in districts or in seats where Biden won in 2020. These people won in 2022. This was a midterm election. There's a big difference between a general election and a midterm election, especially with the House. Remember, if you have someone at the top of the ticket, with the House, you have that coattail effect. Somewhat applies to the Senate, applies to the House a lot more. If you had to ask me, again, opinion, I've been wrong before, I'll be wrong again. But whoever wins the presidency, probably you're going to see the House go that way. If we have a President Harris and a Democratic House, there's still a fairly good chance that the Republicans are going to pick up the Senate. We'll have divided government, which, by the way, isn't the worst thing in the world. Markets sort of favor divided government over the long term. And then in the presidential election, boy, this has changed a lot in the last 5 weeks or so. I've been talking about the election since March. I think I did my first meeting like this probably in March. And I said at the time, we're in the really early innings of a 9-inning baseball game. And we could see some rain delays in there too. And we've seen, meaning there's a lot of twists and turns, right? Someone said, hey, we're going to see extra innings. We might see extra innings too. I don't know, day after election, if we're going to know who's won the White House. It's going to be very, very, very close. The main, there's a lot of points on the slide, but the main thing that has shifted is that before President Biden dropped out of the race, the election, the cycle was really about a referendum on his presidency. And it shifted to more of a choice. If I'm a Democrat strategist, I want it to be a choice. I don't want it to be a referendum. The referendum, that scenario was not working for the Democrats. It was not working for President Biden. It wasn't working for his polling numbers. It's shifted less of a referendum to more of a choice between two candidates. I think the Republicans will try to tie Harris more to the Biden administration, but I'm not sure they've done a good job of that so far. I mean, both sides are, we're razor thin right now. And just remember, if you're seeing, we look at battleground polls, okay? I don't have it in this one, but we look at the usual suspects, right? Pennsylvania, Wisconsin, Michigan, Nevada, Ohio, Georgia, Arizona, Michigan, let's say Michigan. The usual suspects, those 6, 7, 8 states, right? So we look at battleground polling, which is basically it's razor thin right now, right? But if you do look at national polls, just remember one thing, is that if I'm with the Harris campaign, I want to see a national poll where we're winning by at least 3, probably 4 percentage points, okay? If it's tied nationally, that's a good sign for the Trump campaign, because all you have to do is win the Electoral College. With the Electoral College in our system, the Democrats waste more votes, just the way the math works out, especially in California. You only need to win a state by 1 vote. They win California by millions of votes. So just the way the Electoral College works out, that Biden won in 2020 by about 4.5 points nationally, the national vote, right? And it was pretty razor thin when you talk about the Electoral College, especially the margin of error in certain states like Georgia, okay? So if you see those, so if it says, Harris is up by 3 or 4 nationally, Electoral College, it's probably pretty close to being tied, just something to watch for. And then lastly on the election, a couple of things we're looking at, these indicators, and they're sort of fun, right? Nothing's perfect, and we can't predict any of this. We look at equity market performance. That's been a pretty good indicator for the last 100 years. And generally, 90 days leading up to Election Day, is the market up or down? If it's up, the incumbent party usually wins the White House. If it's down, the challenging party usually wins the White House. Pretty simple. We look at something called the misery index. What has that done over the last 12 months? Misery index is inflation plus employment. So CPI plus current employment. If you add those two numbers together today, I think we're at 7%, maybe 7.1. 12 months ago, those numbers added up to 7.3. So it's basically slightly favoring the Democrats, but not by much, really. It's basically a wash at this point. So if we see a tick up in unemployment or a tick up in inflation, that would typically benefit the challenging party, right? And that indicator's worked 15 out of the last 16 cycles. And then there's other areas like third-party candidates. Now that RFK Jr.'s dropped out of the race, what type of impact is that going to make? We'll wait and see on that. But right now, anybody's guess. We're in a 50-50 world right now. Okay, so let's segue for the last part of my conversation. I'll kick it over to Taylor. Is we're going to talk about taxes. So does everyone understand that for the most part, our individual tax system, okay, expires at the end of next year? Does everyone understand that? Sort of a weird thing in the tax code. This was signed into law late in 2017. So basically, if Congress does nothing, not out of the realm of possibility, okay? The probability of Congress doing nothing is greater than 0, right? We'll say that. If they do nothing, we go back in time, and all the rules that were in place before that 2017 law apply again. And I'll show you. And largely, if you're talking about the tax rates themselves, largely that's not good. So this is married couples filing a joint return. And I'm just overlaying the current tax rates and brackets on with what would happen if everything expires, if Congress does nothing. And you see in the red on the right-hand corner, that's the difference. It's not just going from 37% to 39.6% for people over $730,000. No, that's part of it. But look at the second lowest bracket actually goes from 12% to 15%. I don't think anyone's focusing on that. So this tells me I think it's more likely, regardless of what happens with the election, Congress is going to try to avoid having it just expire across the board. Remember, the president has no control over this. I love how the media says, well, you know, whether candidate Trump, candidate whatever, they want to keep this stuff and they want to, you know, pick and choose which things they want to expire. No, they don't have any control. Everything expires unless Congress takes action. And obviously the White House will be part of that, right? But that kills me on whether they talk about it. So do I think, whether it's Republicans in Congress, Democrats in Congress, do I think they want a tax hike on the people in the second lowest bracket? I do not. I do not. I think they're going to have to deal with this. I think at the very least, there's going to have to be a mix of some things expire and some things don't. If the Republicans win, they're going to want to extend everything. Just keep it going as it is. That's what they're going to try to do. Okay? And we'll come back to that. And I'm not saying that they're going to be able to do that, even if they have a majority and if they even have control all, you know, the White House, the Senate, and the House. It's going to be an expensive proposition, you know, cost-wise. I mentioned this is, it's not just about the rates. Here are just a sampling of some tax provisions: standard deduction, alternative minimum tax, estate and gift tax. And here, you know, we're comparing, and we have this in a piece that we can get you to. Here's where you're at today. Here's where you're at if everything expires as scheduled. Remember, that's the default. Congress does nothing, we get expiration, and we go back to 2017, basically. Alternative minimum tax jumps out at me. Hardly anyone pays alternative minimum tax because they sort of made a change in the tax code that sort of fixed it, and so a lot of people don't pay it. If this expires, we go back to 6 or 7 million taxpayers paying AMT. There's a lot of people that paid alternative minimum tax for years, and they haven't paid it since the 2017 law. They'll pay it again if it expires. And other things like the federal gift and estate tax. Not going to affect the Cass family, okay? As a married couple, today you can shelter almost, you know, you can shelter around 27 million from federal estate tax of your net worth. I have 2 kids still in college. My net worth is continuing to go down, unfortunately, with 2, but we're at the end of the, we're almost there. So we're going to watch that as well. It's not going to affect, if we see a change in the estate and gift tax, it's not going to affect many people, but who affects, they're going to want to try to get out in front of that and do trust planning and some other things. All right, so outlook on taxes. I've talked a little bit about this. GOP sweep. The priority is going to be to extend what we call the Tax Cuts and Jobs Act, basically our tax system, for some period of time. I think the longest they would extend it would be 5 years. Maybe they extend it 2 or 3 years. I don't know. But here's what I'm saying to people who think if the Republicans win everything, then it's a no-brainer. We're just going to extend. All the tax code is just going to extend. No problem. I'm not saying it's not going to happen. I'm saying it's not a no-brainer. They're going to have, you know, tough discussions in the Senate. They would have a very, very thin margin in the House. So and it's going to be a significant cost issue. Both parties are equal opportunity spenders, by the way. Okay? I don't put it above Congress to like to spend money, right? But we're in a different cost structure with the interest on the existing debt especially. The interest on the existing debt has quadrupled over the last 5 or 6 years. So that's more of an issue. Democrats sweep, they're going to try to retain the tax system and brackets and whatnot and rates in place for people under $400,000 in income, and tax rates for others will go up. They're going to try to raise the corporate tax rate, which is 21%, up to, let's call it 25 or 28%. I don't know if they're going to be able to do that. Question here. Yeah, so it's because you think about your credit card debt, right? If the interest rates are great, then you don't have much interest, but the interest rates have gone, over the past 2 or 3 years, just like mortgage rates have gone up. To give you a sense, I think I looked at, we were paying for years around 200 to 250 billion in interest costs a year. And last year it was almost 700 billion. It's projected for this fiscal year that's ending at the end of September, it's over 800 billion. Now, as interest rates, you see the mortgage rates started to come down. So hopefully that will help out. But again, even if interest rates come down a bit, you still got this, you still have interest on more debt. So you're still going to have that. It's just that debt cost is something that we have to contend with as a country. And then if we have divided government, I think, again, I think there's going to be a vested interest not to just let it expire, because I think people are going to try to avoid a tax hike on those in the second lowest bracket. And then there's some other problematic issues within the tax code if this thing expires. So, that's our outlook. If I had to take one of those three, regardless of what happens, I'd say we get something in the middle. I'd say we get some provisions expire, others don't. People at higher income or higher wealth levels are going to be paying more in taxes. For people in higher income levels, even if there's an extension, I think it's a matter of time before you pay higher taxes because of the interest on the debt, Social Security, cost of Medicare, et cetera, et cetera, et cetera. I think you just got, planning-wise, you have to sit down with your team and say, hey, how are rising taxes 5 years down the road, 10 years, 15 years down the road, how is that going to impact me? And are there some strategies I can take today, looking at Roth accounts or other things? It's not for everybody, but are there some things we can do today to sort of hedge ourselves a little bit if taxes are higher 5, 10 years down the road? That would be a conversation I'd go back to your team at MRK and have about your personal situation. So for some of you, it might be, nope, we're in good shape. Because of, your income needs and whatnot, you might be in good shape and maybe doing nothing on the tax front or using Roth accounts makes sense. But I would encourage you to have that conversation. So with that, any last questions? I'm going to be here around too, so I'm not going anywhere. Question here? Do you expect policy changes on the Roth conversion? Great question. Question for folks over here. Do you expect policy changes on Roth conversion? I do not. But I like this question because some people say, hey, maybe I'm going to move my traditional IRA to a Roth. I'm going to have to pay the taxes today, but geez, I get tax-free income for the future. That's great, right? But the next question is Congress going to change the rule? Is there some way Congress is going to get me? It's almost like Social Security, right? Social Security benefits were never taxed. Then starting after the 1983 Social Security Reform Act, they started taxing, they had to. They started taxing a portion of benefits because they needed, they were running out of money. Basically the same situation we're in right now. So I would say no, I have not heard anything, but that might be one of the reasons why I want to be balanced. I might not want to put all my eggs in the Roth basket. Again, I haven't heard talk. If anything, Congress has been expanding Roth because they like to get the tax dollars today. But great question. Any other last questions? And again, I'm going to be around here. Taylor, do you want to come up and share your wisdom on the markets and give us some predictions on where the market's going? All right, great. Thanks, everybody.
All right, good afternoon, everyone. I did notice that I think Bill's mic went out halfway through, so if you can't hear me back there, jump up and let me know. But I'll try to keep my voice up. Taylor Spusas, market strategist with Franklin Templeton. It's good to be here. Thanks for having me. Ann mentioned at the outset that I'm from Boston or living out in Boston. I actually grew up here in Minneapolis. I went to Benilde St. Margaret's and just returned at the end of last year with my wife to move back to the Plymouth Wayzata area. So it's great to be presented in front of a local audience. Today, what I want to go over is our capital markets outlook. So what we think about the economy, about the equity markets, and about the fixed income markets. It's super nice to be traveling with Bill during election season because generally when I'm out traveling the country, talking to advisors or talking to clients, I get asked about, what does the election mean for markets? And I think the quick answer is it really doesn't matter all that much who's in the White House or who's in Congress, especially for long-term investors. So it's nice following Bill, who can go over some of the tax implications, some of the estate planning implications, because those things are very real, and planning considerations are impactful. But in terms of the markets, what really matters for markets in our view, what drives markets over the long term, it's the economy, it's central bank policy, it's the direction of interest rates, and it's corporate earnings, or how profitable are companies, and are they able to grow those over time. So I'm going to go through each of those. I'm not going to go through the economic agenda or policy of President Trump or Vice President candidate Harris, mostly because I think details are still a little bit sparse, but also I think in practice the outcomes and what it means for markets is the evidence is that it's not that strong of a connection. So I think just to look back, when I look back at President Trump's 4 years in office, can anyone guess what the best performing sector in the S&P 500 was during those 4 years? It was not real estate, it was technology. So technology was up about 170% in those 4 years. The worst performing sector, can anyone guess, during those 4 years ended in 2021? Energy. Energy was down 35% over those 4 years. Since Biden took office, the best performing sector has been energy. Energy is up 100%. The worst performing is consumer discretionary. The reason I bring that up is because you'll probably see in the media a lot of talk about, this sector is going to perform best if President Trump wins, or this sector is going to perform best if Harris wins. And oftentimes it'll point to something like energy or healthcare or financials. And I think while these policies do matter, certainly for the business owners, for industry, I think there's more important drivers for businesses, especially over the long term, and how these policies get implicated are not all that apparent beforehand. So that's just a little background. I'll have more data to go through on the election side, but why don't I start out with going over the macro, going over the economy. What are our views on economic growth here? I would summarize the economic picture as one where there's pretty solid growth in the U.S., but it's slowing. Growth is slowing from very solid levels in 2023, where real GDP growth was over 3%. This year, our projection, and sorry if this is hard to see, but our estimate for real growth in the U.S. is somewhere around 2.3%. So slowing from 3%, but still pretty positive. I would say that that's going to provide a pretty solid base, or has provided a pretty solid base for U.S. companies' profits. As we look globally, I would say it's a similar story, where growth is slowing. We're not quite to recessionary levels in our view, but things are slowing from pretty strong levels. And that extends to Europe, developed markets, where just as a category or as an area, growth should be a little bit weaker than the U.S. And then in emerging markets, again, slowing growth, but solid growth, just not the growth we were used to for the 10 years preceding the pandemic. So slowing growth, but still solid. On the inflation side, inflation is moderating. It's still higher than what we've been used to. We expect core inflation to end the year around 2.5% or a little bit higher. There's an important report tomorrow morning. We'll get more evidence on that. But I think generally, where the last 2 years, the focus on the economic side has been about getting inflation under control. The Federal Reserve has increased interest rates in order to slow the economy to get inflation down. I think now the conversation has turned from one of worrying about inflation to worrying more about growth and the labor market. So while we do see inflation moderating here, we think the Fed is going to start cutting interest rates at the end of next week. In the September meeting, the Fed is probably going to cut either 25 basis points or 50 basis points. I think it's not all that important to us predicting what the level is in a month, but what we do think is going to happen is over the next 6 to 12 months, the Fed is going to cut interest rates by quite a bit to get the interest rate at the very front end of the curve down towards 3 or 3.5%. So the Fed is going to start cutting interest rates in September. That's almost a sure thing at this point, and it should continue into next year. So interest rates should start to drop. They already have quite a bit to Bill's point a little bit ago, and we'll get more into that on the fixed income side. But that's the important part about the economy, about inflation, about the Fed. Why don't I pause there, see if there's any questions on that before moving over to the stock market and equities. All right, so let's move over to equities here. I think just to quickly summarize our views on equities, at this point I would say we're cautious, not in the sense that we're selling out of positions or that we're de-risking. I would say we're more in a stance of waiting for more opportunity to put money into the market. So why are we cautious? You'll see our S&P 500 target there is 5250 for year end. The way we get there is we ask all of our equity portfolio managers at the firm. There's over, I think, 125 of them, where they see the S&P ending. 5250 is the number. It's not a whole lot more science than that. But why are we cautious when the current level of S&P 500 is about 5,400, so maybe 8% above our target? It has to do with the earnings picture. So we believe that over the long term, stock prices follow earnings and earnings expectations. So right now, the market is expecting earnings to grow at around 10%. Our equity portfolio managers expect it to grow earnings or profits for S&P 500 companies closer to 7%. So pretty good growth in our estimate, but a little bit below the optimistic scenario from the street. So that leads us to be a little bit cautious here. We also know that historically leading into elections, that volatility tends to increase in each month, ending in November, and then it starts to go down a little bit. So we would expect some volatility. We really haven't had any volatility the past year except for a little bit around the Japanese yen carry trade about a month ago. That has gotten a lot better, obviously. So we do expect volatility to increase. We would use that volatility, we would use those corrections as opportunities to add into areas of the market that we like moving forward. And namely, what do we like on the equity side? I think the most important thing in our mind is quality companies, high quality companies, whether it's growth or value, small or large. I think the most important thing is going to be quality. So what do we mean by quality? It means profitable companies. It means companies with less debt on their balance sheets and companies that should be able to grow even despite any economic weakness that comes. And then just in terms of areas, we do like the U.S. equity market. We do like some areas of developed markets, international, thinking Japan, thinking the UK, and then in emerging markets, we're comfortable owning EM, especially if you can do so in a way that doesn't have as much exposure to China. International has trailed by quite a bit over the last 5 to 10 years. We think now that there certainly is opportunity for the earnings to grow for European and developed markets moving forward, along with the U.S. I mentioned earlier the point that earnings follow, or equity prices follow earnings. This graph just shows this. It's probably hard to see, but the bottom axis there shows earnings growth. On the left is price. This goes back 15 years. You'll see in the top right, the United States earnings have grown in the last 15 years by almost 200%. The stocks are up almost 500%. If you look at Europe, why has Europe lagged the U.S. over the last 15 years? I think you can point to the earnings picture where earnings are up about 50% over the last 15 years, and stocks in Europe are up about 150%. Right? So U.S. earnings have grown by, call it 4 times Europe, and the stocks have outperformed by about 4 times over those 15 years. Right? So that's the story. Where are we going to see earnings moving forward? I think there's a case for Europe to rebound, and I think we still like the U.S. moving forward due to the innovation here over the next 5 to 10 years. I think the next important thing that I mentioned at the outset is the Fed is going from a regime of increasing interest rates to slow down growth, to slow inflation, to one where they're cutting interest rates in order to get back to a more normal or neutral level. So we look back over the past 50 years at how have equities performed after the Fed starts cutting interest rates. This is split in half. On the left, you'll see here are returns after the Fed cuts interest rates when we're not in a recession, and on the right, when we are in the recession. So 1 year out, regardless of whether it's an expansion or a recession, stocks have finished higher. On the left, you'll see the average returns, S&P 500 have been 17%. On the right, the S&P 500 12 months after during a recession, up 5%. So still positive, but again, better returns when we're not in a recession. I think that's pretty intuitive. From our point of view, we're not in a recession now. It's not going to be knowable, unfortunately, until after. I think the one important thing to point out on this is the volatility. If we are in a recession, you can expect more volatility in the first 3 to 6 months after the Fed starts cutting interest rates, but then it'll come back and end up higher if history is any guide for us. And then this, unfortunately, this chart is a little bit busy. What this shows is market performance during different political regimes. So there's 6 different types of government possible. You can have a Republican president with a split Congress. You can have a Republican president with a Democrat-controlled Congress, and vice versa. So this shows returns since 1932 in each of those 6 scenarios. You'll see, well, you probably can't see, but on the far left, you'll see the best returns on average have come under a Republican sweep, up 16%. The second best returns have come from a Democrat president with a split Congress, up 15%. The next 2 best returns were a Democrat president and various Congress regimes, and then the lowest 2 were the other 2 Republican regimes. So the reason we bring this up is just to show that I think for us this is a little bit random. There's not too much to take away other than this is going to change every 2 years, and there's more important things, and all the things we just discussed on the last few slides are really what we focus on rather than predicting your returns based on who's in office. The next slide is bonds. Any questions on equities or anything I covered before switching over to the bond market? All right, so for fixed income, this has been, I would say the problem for most portfolios over the last few years, where bonds traditionally have been, the ballast or the reliable, consistent part of portfolios. And over the last couple of years, it's been a struggle. The reason for that is because, how bond returns work typically is when interest rates rise, the prices of bonds fall. So we've been in an environment where the Fed is increasing interest rates from 0% up to 5%. The rest of the bond market has followed suit with interest rates rising, and so the value of the bonds have gone down. As we've talked about, we think we're now in a regime where the Fed is going to start cutting interest rates. We've already seen interest rates fall a little bit so far this year, with the 10-year moving from 3.8% up to 4.4% and back down to 3.8%. So we've seen some stabilization in the bond market. I think most bond indexes have now gone back to even performance year to date. We do think that bonds will return to the traditional return expectations that we've had before this bout of negative performance. So we like owning fixed income here. We think it's going to be important as a diversifier moving forward, and we do think that bonds should benefit as the Fed starts to cut interest rates. So we're positive on owning bonds, especially we've been talking a lot about moving out of cash, out of CDs, and adding a little bit more into bonds on the short end of the curve or the middle part, just to take advantage of the anticipated drop in interest rates. And then more broadly, I think when you think about corporate credit or the bonds of U.S. corporations, we're positive there just because we expect earnings to continue to grow. And we think that's, from a fundamental perspective, we like owning both corporate bonds and the bonds, treasuries of the U.S. government. I think the last slide I'll show here, this just looking back at the same chart, the last 50 years, looking at the biggest drawdowns in equity performance. So this will be the bottom. You'll see what were the steepest declines in the S&P 500, or how much did it fall over the course of a few months. For instance, in 2019, 2020, after the Fed cut interest rates, markets dropped 24%, and you'll see pretty big sell-offs across the board on the bottom. The blue bar on the top shows bond performance during those same periods, those same sell-offs. And what you see is that typically when the equity market drops a lot, bonds do quite well. So in 2019, 2020, the S&P 500 was down 24%. If you owned a bond portfolio that's depicted here, the bond index, you returned 8% and vice versa across. So what this the reason I showed this in here is that we do expect volatility, as always, within equity markets. And like history, we would expect that when the equity market sells off, that bonds should provide a good ballast and a good diversification source within portfolios. So when we see the market down quite a bit, we do have confidence moving forward that bonds should provide, again, solid returns in those perspectives, so long as interest rates continue to move lower. And I'll pause there. I think I've covered a bit and see if there's any questions on anything I've covered. Otherwise, we can end things there. All right, awesome. Well, appreciate the time, and I can turn it over to anyone else who wants to close this out.